Good morning, friends. In our previous videos, we have discussed components of Indian financial system, financial assets or instruments, etc. Now we move to the next another video that includes classification of financial assets, functions of financial markets, types of financial markets, etc. Let us move the classification of financial assets. Classification of financial assets. Financial assets can be classified in different ways. We are discussed all these classification in detail in these videos. Very important type of classification consists of primary assets and secondary or indirect assets. Primary assets is also known as direct assets, whereas secondary assets we call it as indirect assets. Primary assets means financial claim against real sector units created by themselves for raising funds to finance their deficient spending. They are the ultimate borrowers. Whereas secondary assets are financial claims issued by financial institutions against themselves to raise funds from the public. The difference between these two assets are one is to finance their deficient spending and another one that is raised fund from the public. Secondary financial assets are the obligation of financial institutions. Primary assets, let us have a different examples for primary assets. Examples are bills, bonds, equities, etc. Bank deposit, life insurance policies, UTI units, etc. are the examples of secondary assets. Next classification, that is marketable assets and non-marketable assets. From the term it is very clear, marketable assets are the financial assets which can be transferred from person to person without any difficulty. Easy marketing is possible on these assets. It consists of shares, government securities, bonds, mutual funds, etc. Bearer debentures are also under the category of marketable assets. While we are looking to the non-marketable assets, these are all the assets or financial assets which cannot be transferred easily. It mainly consists of bank deposit. As we know that bank deposits is an asset which cannot be transferred easily. Same as provident fund, LIC scheme, company deposit, post office deposit, all these are coming under the category of non-marketable assets. Another important classification of financial assets are cash assets, debt assets, stock assets. Let us see one by one. First one, cash asset. It is also known as money asset. Money asset or cash asset consists of, we know that money is a coins or a currency. So money asset or a cash asset is consist of coins or currency notes and created monies. We know that Reserve Bank of India has the sole authority to issue notes or currencies. Whereas in the case of commercial banks, these are create money by creating credit. We are already learned credit creation of commercial bank. Then another one, that is debt asset or debt capital. We know what is meant by debt capital. It's a term loan. Different type of organization issues debt assets for raising fund debt capital. Debt capital, there is a fixed time schedule for repayment of principal and interest. Always these carry a fixed rate of interest. Debt capital is raised by way of issuing debentures or bonds, raising long-term loans, etc. Another one, that is stock asset. We know what is meant by stock. Stock includes two types of stocks we have: preference stocks and equity stock, or equity capital or and preference capital. Corporates or companies issue stocks for the purpose of raising their fixed capital. There are mainly two types of stocks, such as preference share capital, equity share capital, or equity stocks. We know that equity stockholders are the real owners of the company or corporate or organization, whereas preference shareholders have a preferential right to get a fixed percentage of dividend if there is a profit. Next, nature of financial market. We know that financial market is the backbone of our Indian financial system or economic system. The financial system of an economy works through financial markets and institutions. We know financial markets are the center that facilitate buying and selling of financial instruments. Financial markets are critical for producing an efficient allocation of capital, allowing funds to move from people who lack productive investment opportunities to people who have them. Financial market deals with the financial assets or instruments of different types, such as currency deposits, check, bill, bond, etc. We know that there are different financial institutions or players in the financial market. The main participants in the financial markets are financial institutions, financial agents, brokers may be financial institutions or merchant banks, etc. Then dealers, money lenders, borrowers, and savers, lenders, or other important who are interconnected by law, contract, or connection network, etc., are the major players of the financial market. By concluding these elements, financial markets that cater the credit needs of the individual firms and institutions. Next, we look into the role of financial market. We are already discussed the nature of financial markets. The next role of financial market. We know, while we are discussing the nature of financial market, we are already go through the role of financial markets, how far these financial markets are influenced for strengthening our Indian economic system or financial system. These points, that is very clear to understand the role of financial markets. These financial markets that generate and apportion of credit, and it also helps for intermediaries of mobilizations of savings. And another one, it provide convenience and benefit to the lender and borrowers. And the last one, they promote economic development through the a balanced regional sector allocation of investable funds. From these, it is very clear financial markets are acting as the link between the developing or underdeveloped and developed, or it is the bridge. It helps to bridge the gap between developed and underdeveloped. Then we can see functions of financial markets. From our discussion, it is very clear a number of functions of financial markets. A borrower or a lender cannot find the real destinations without the financial market. Financial market that helps to remove the difficulty faced by the lenders and borrowers, that helps for functioning or smooth functioning of lenders and borrowers. These are the intermediaries such as banks helps in this process. So it is very clear by looking these points, functions of financial markets. Let us briefly explain these points. First one, that is borrowing and lending. It's very clear from the term, it is very clear. Financial market that helps to or that permit the transfer of fund from one agent to another for their investment or consumption purpose. And another one, that is price determination. It's a very important function of financial markets that helps, that provides means by which prices are set both for newly issued financial assets and for the existing stock of financial asset. It may be based on the demand and supply basis or other method they follow. Even anyway, that financial market that helps for determining the price of existing shares or newly issued shares. And another one, that is information aggregation and coordination. It means financial market act as a collectors and aggregators of information about financial assets, values, and the flow of fund from lenders to borrowers. From this, it is very clear that financial market helps to provide the pulse of the market or pulse of the financial assets. And another one, that is risk sharing. Financial market allow a transfer of risk from those who undertake investment to those who provide fund for the those investors. And next one, that is liquidity. All of you know liquidity, that means provide the holders of financial asset with a chance to sell or resell to ensure the liquidity of financial asset. And the last one, that is efficiency. Efficiency means that to reduce the transaction cost and information cost. It helps to boost the efficiency of the financial markets. From these, by all these points, let us conclude today's discussion here. Thank you. Thank you for all.